Do you think that the Fed's doing the right thing?
No, I don't. In a word, I think that what they're primarily missing there's a number of things I disagreed with today. First of all, Chair Powell has a thesis that because the unemployment rate has been stable, the labor market is roughly in balance. He's ignoring a plethora of indicators that suggest that labor demand is actually weakening faster than labor supply, and the amount of slack in the labor market is getting worse. So while he might consider the unemployment rate the most important indicator, I would point to wages, and particularly wages for the lowest income quartile. The Atlanta Fed releases these numbers about 3 days after the monthly payroll report, and they've been falling sharply, as have wages for workers that are switching jobs, which indicates that demand is weak, the turnover in the labor market, which drives productivity over time, is weak. This week's JOLTS report showed a big drop in the hiring rate, quits rate, and job openings. Those job openings are probably overstated. Even Chair Powell said himself, corrected for the way the BLS calculates and then trues up the data 9 months later when they actually go through IRS records, it's likely that job growth in the private sector is zero right now. So I think he's taking and the committee is taking an undue amount of risk with the labor market and having no real impact on inflation. The market sent very clear signals after Liberation Day that the pandemic was likely to be a bigger problem for growth, and in fact it has. Rick described GDP as beating slightly, but when you look at core measures, the PDFP measure, which Chair Powell referenced, which is real final sales to private domestic purchasers, consumer spending, all of those measures have come down sharply. We see the same thing in corporate earnings. Corporate earnings for consumer discretionary companies, staples companies, are negative, and their revenue growth has slowed sharply. So these companies are getting hit in margins, demand is weaker, and the Fed should have been easing right now, and the market clearly was disappointed that they didn't. Of course, we're looking at S&Ps up in after hours because of Microsoft and Meta, but if you look at the Russell 2000 futures, those are down about 60 basis points, the most cyclically sensitive part of the equity market. So no, I think he took a real risk, and it could create problems for equity investors. I understand we've had a relentless rally, but recalcitrant Fed here with decidedly slower growth, we may get a little bit of a growth scare crack up as we've had a number of Augusts recently.
So where do you think equities go from here? I mean, it sounds like the Fed is willing to sacrifice jobs and wages in favor of taking out a little insurance and protection against inflation rearing its ugly head all over again. I mean, in some of the commentary from Powell, it's still early days on inflation in terms of its impacts from the tariffs. We expect to see more tariff impacts on inflation data. Do you think that focusing on inflation over jobs is the right way to go? And how do you think equities will take that going forward?
No, I don't. I don't think they understand how the inflation process really works. I think they underestimate the impact of government spending. And if you looked at this morning's numbers, you saw government spending down sharply at the federal level for the second quarter in a row after just booming during the entire Biden administration. Those extra dollars that were mailed to everyone in the forms of checks in 21 is what drove the inflation spike. And so, that piece, and Treasury Secretary Bessent described it as the detox from our addiction to government spending. That's what drove the inflation in 2021. So they're getting this wrong. Service sector inflation is weaker. Housing inflation is coming down and likely to come down very sharply in the second half of the year. So they're getting that piece wrong. When you look at the equity market, it's really a tale of two cities, so to speak. The sectors that face the consumer, the discretionary and staple sectors I just referenced, have a real problem here. And the problem is weaker demand and pressure on profit margins from the tariff tax. Anything related to investment, so technology sector to be sure, but the industrial sector, which is the best performer this year, is anticipating this shift to, a real reacceleration of capital spending, partially as a result of the One Big Beautiful Bill Act that is creating pretty strong incentives for investment. So those parts of the market are strong. One of the things I thought would be a tailwind that would cause the equity market to potentially look through this, detox, soft patch, and growth was the probability that the Fed was going to start easing policy. We saw the Russell 2000 break above its 200-day. Small banks start to pick up their head when it started to edge towards the Fed easing. But if we get a round of speeches from Fed officials that imply September is far from a foregone conclusion, then getting that growth scare scenario where we get a modest sell-off, is increasingly likely.